Dinar shift. Something truly significant is currently dominating the global currency discussion, commanding the attention of millions, who are eager to debate, dissect, and question its implications. Across every imaginable platform, from specialized online forums and high-traffic live-stream chats to private Telegram groups and influential financial analysis channels, a single potent claim has become the source of intense community buzz. This claim suggests that a major worldwide coordination effort might be unfolding right now, involving central banks, regulatory bodies, and various financial institutions, with a specific focus on the Iraqi Dinar, IQD, and the Vietnamese Dong, VND. For many long-term participants, the perceived signs of alignment feel stronger than ever before. However, a significant countervoice urges extreme caution, dismissing the claims as exaggerated rumors and warning viewers to maintain a grounded, informed perspective and wait for verifiable official confirmation. Despite the division, one fact is undeniable: this conversation is escalating rapidly and intensely. Today's deep dive is dedicated to systematically walking through the core components of this developing story. We will meticulously examine what specific details sparked this latest and most fervent wave of discussion. We'll explore why the community is so fixated on the claims of banking synchronization, analyzing the vastly different viewpoints held by optimists and skeptics. Critically, we will assess what this speculation could realistically imply for anyone who tracks these particular currencies, emphasizing factual observation over sensationalism. Whether you've been a dedicated follower of the IQD and VND narrative for years or are a newcomer drawn in by the current excitement, it is essential to stay engaged with every detail, as each piece of information is crucial to forming a comprehensive, accurate understanding of the unfolding situation. In recent days, keen observers within the currency community have noted an unusual and widespread proliferation of conversations across virtually all digital channels, from specialized podcasts to social media and online update feeds. These discussions allege that banking institutions around the world are actively engaged in preparing their internal systems or aligning their procedural frameworks in connection with the Iraqi Dinar and Vietnamese Dong. Individuals who monitor these currencies for any subtle change are habitually alert to even the slightest hint, no matter how small, that might suggest potential market movement or structural reorganization. The reason this moment has achieved such prominence is the unique, multi-source nature of the discussion. The claims are not originating from a single isolated source, but are spreading concurrently from numerous, disconnected corners of the broader currency community, creating a sense of powerful, simultaneous confirmation for some, and a strong signal for caution among others. The central question now being aggressively debated is whether banks operating in different global jurisdictions would realistically coordinate policy changes at the same moment, and if such a massive synchronization effort would undeniably signal a major event for those anticipating a currency revaluation. Proponents of the coordination claims argue that this scenario is plausible because international banks routinely update their software compliance rules, overhaul cross-border transfer systems, and refine global regulatory alignment on cyclical schedules. They interpret the current simultaneous timing as a deliberate sign. However, critics vehemently counter that similar timing in banking updates is a common operational reality and does not in any way guarantee a direct connection to a potential value adjustment for the dinar or dong. Nevertheless, the sheer volume of these claims highlights the community's intense vigilance and the extreme speed with which even the most tenuous hint can rapidly spiral into widespread speculation. What makes the current environment particularly compelling is the stark contrast in community reactions. One faction is deeply convinced that the observed bank updates, which they claim involve internal memos, updated foreign exchange communication standards, and stricter documentation requirements for certain currencies, are deliberately synchronized signals that indicate a much larger, coordinated plan involving top-tier international financial bodies. They view these patterns as undeniable evidence of preparation. Conversely, the skeptical groups maintain that banking institutions continuously refine their operational systems for countless reasons wholly unrelated to dramatic currency events, such as mitigating fraud or improving efficiency. They argue that community members may be drawing speculative connections between entirely separate and independent activities. While this fundamental clash between fervent optimism and deep skepticism is a recurring feature of the currency world, the current intensity and synchronization of the discussion feels significantly stronger than in previous cycles, drawing attention far beyond the usual confines of the speculative community. Adding further fuel to the circulating claims is the specific nature of the anecdotal evidence being shared. Some voices within the community assert that they have communicated with contacts within regional banking sectors who have reportedly confirmed the scheduling of specialized training sessions or the implementation of system adjustments, often occurring during unusual hours or under uncharacteristically stringent internal guidelines. These individuals frequently characterize this activity as crucial, behind-the-scenes preparation. However, they are consistently unable to provide definitive documentation due to strict privacy protocols and professional compliance restrictions, leaving the claims unverified. On the other side of the debate, opponents strongly emphasize that this type of unconfirmed banking chatter is a regular feature of the community, appearing and then fading every few months without ever leading to any measurable or official outcome. Yet, the underlying possibility of banks coordinating changes across national borders is not inherently unrealistic. Major global financial institutions routinely engage in international standard updates, essential compliance modifications, and massive digital payment infrastructure improvements. These efforts can appear synchronized externally simply because they adhere to shared global regulatory calendars or fixed implementation deadlines, unrelated to any specific currency revaluation. The primary analytical challenge for the community lies in definitively determining whether the current wave of banking activity is directly related to the IQD and VND, or if it merely represents a routine segment of the necessary ongoing modernization of the global financial system. This inherent uncertainty is the wellspring of the continuous, intense debate. The ongoing conversation is a fascinating blend of profound hope, measured caution, rampant speculation, and subjective personal interpretation. Many longtime community members, seasoned by years of following these currencies, describe their current approach as one of patient, objective observation. They acknowledge the eventual possibility of major economic changes, but stress the importance of not preemptively leaping to conclusions without explicit verified indicators. In stark contrast, another group feels powerfully that, following such an extended period of waiting, this alleged global alignment, if it proves real, could represent the vital missing piece required to unlock a major currency adjustment. This faction points to complex patterns in international commerce, digital platforms, and cross-border payment mechanisms that appear to them to be explicitly preparing financial systems for a new, more integrated environment. For the optimists, this observed preparatory activity makes the idea of worldwide coordination seem not only possible but entirely logical. However, external financial experts, independent of the community, consistently remind the public that national currencies rarely experience sudden, dramatic, or unexpected changes. Such significant adjustments are almost always preceded by months or even years of officially documented planning, public announcements, multilateral negotiations, and clear, structured regulatory guidance. These contrasting perspectives generate a highly dynamic conversation, one that is both deeply hopeful and critically cautious, intensely curious yet committed to objective analysis, and constantly scanning the horizon for the next concrete sign. At the very core of this intense global discussion are the two currencies that started it all, the Iraqi Dinar and the Vietnamese Dong. Each possesses a distinct economic profile, facing unique national challenges and holding specific long-term growth potential, which is precisely why they maintain such a devoted global following. The dinar's enduring attraction is often linked to Iraq's significant natural resource wealth, the country's vast ongoing reconstruction efforts, and the progressive development of its financial sector. The Dong, on the other hand, garners interest due to Vietnam's robust, long-term national growth strategies and its rapidly expanding pivotal role in the global manufacturing supply chain. Both currencies command a passionate base of followers who track every official government statement, market fluctuation, and change in banking procedure. Consequently, when claims begin to spread that international banking systems are adjusting their infrastructure in a manner that might connect to either of these currencies, it inevitably triggers an intense and widespread communal discussion. Some believe these reports could signify preparation for a more accurate, internationally balanced recognition of their values. Others underscore the fact that both currencies operate within extremely complex economic ecosystems, meaning any significant value adjustment would require comprehensive, broad support, impeccably clear planning, and the essential element of formal, verifiable confirmation. Irrespective of the specific views held by individual participants, the level of continuous, dedicated attention these two currencies receive remains almost unmatched within the sphere of alternative currency speculation. The very claim of worldwide banking coordination naturally prompts a set of deeper logistical questions within the community. What, precisely, would such coordination entail on a practical level? How would banks spanning various continents practically execute this? And what overarching purpose would it serve the global financial system? Some community members envision a highly synchronized scenario where international banks adjust their exchange rates at the exact same moment to proactively prevent market instability, such as arbitrage opportunities. They draw parallels to how large institutional systems already synchronize time zones and update digital platforms for simultaneous, seamless transitions across vast networks. Conversely, others point out that synchronized updates might simply be the result of a coordinated rollout of entirely new global settlement rules or standardized banking protocols. For instance, major changes to digital anti-fraud systems, the adoption of new global SWIFT communication standards, sweeping compliance auditing procedures, or sophisticated AI-assisted transaction monitoring platforms often require banks across the world to upgrade their systems within a common fixed timeframe. Crucially, these technical updates typically bear no connection whatsoever to specific high-stakes currency revaluation events. Since these technical banking updates are rarely explained to the public in exhaustive detail, the vacuum of information often fuels confusion and intense speculation among observers desperate to find meaningful timing in the activity. The fundamental challenge for the community is discerning the difference between routine, standardized operational updates, and genuinely meaningful economic signals. Right now, the core of the community's collective effort is attempting to interpret precisely where the current wave of banking activity fits on that spectrum. In this highly charged environment, certain content creators and online commentators have dramatically amplified their coverage, frequently sharing personal opinions, speculative interpretations, or unverified reports from individuals who claim to possess confidential banking insights. These influential creators play a significant role in shaping community sentiment because a large segment of the audience relies on them to translate opaque, complex financial jargon into more accessible language. However, this influence carries an enormous responsibility. When discussions reach such high levels of speculation, misinformation can spread with alarming speed if not handled with rigorous care and fact-checking. Some creators wisely caution viewers that all claims, especially those related to banking, must be independently verified before being accepted as fact. Other creators, perhaps leaning more into the excitement, disseminate rumors that may lack any credible foundation. This dynamic creates a complex, mixed information environment where viewers must develop sophisticated skills to separate genuine analysis from mere assumption. Despite the variances in tone and analytical rigor, there is a consistent consensus that something, whether large or small, is definitely stirring community discussion on a scale that hasn't been observed in many months. An intriguing dynamic emerging from community reactions is the way long-term followers leverage their past experiences to interpret the current situation. Veteran part. Participants often recall previous periods where strikingly similar claims circulated regarding system resets or synchronized banking procedures, only for those moments to pass without any major tangible developments. This historical context instills a deep sense of caution in many of them, leading them to approach this new wave with significant skepticism. Yet, at the same time, another group argues compellingly that the global financial landscape is undergoing a much faster, more radical transformation today than at any point in recent decades. They point to rapid technological advancements, such as the explosive growth of digital banking, international payment interoperability, and the heightened necessity for unified cybersecurity responses across all borders. For this latter group, the idea of international banks coordinating major system changes is not only realistic but may be viewed as an essential requirement for modern financial stability. This powerful contrast between historical skepticism and a forward-looking modern optimism is profoundly shaping how every new update is interpreted within the community. Because both sides present logical, well-reasoned arguments, the conversation continues without a clear, definitive consensus, keeping the entire situation suspended in a state of intense, open-ended anticipation. Another crucial element in this discussion is the profound level of emotional investment many individuals hold in these currencies. For some, tracking the Dinar and Dong has been a decade-long commitment, involving years of studying markets, analyzing geopolitical news, and patiently awaiting economic improvements. This extended commitment naturally generates a powerful mix of emotions: deep hope, determined patience, occasional frustration, and unyielding resolve. Therefore, when a claim as monumental as worldwide banking coordination surfaces, it inevitably triggers a cascade of intense emotional responses. Some community members feel immediately energized and excited, believing that a long-awaited change might be far closer than they had dared to hope. Others adopt a protective stance, vigorously urging the community not to allow mounting excitement to override the absolute necessity of logic and rational thought. This emotional dimension is key because it significantly influences the speed and manner in which information propagates, how quickly speculative rumors take root, and the intensity of reactions to even the smallest, most ambiguous detail. Understanding this complex emotional landscape is essential to explaining why conversations expand so quickly, and why certain unverified claims manage to gain such powerful traction long before any official confirmation is ever established. A further factor dramatically shaping this moment is the sheer overwhelming speed of modern digital communication. Platforms dedicated to social media, video content channels, and instant messaging communities now allow information to traverse the globe faster than at any previous time in history. A speculative claim that might have required days or weeks to circulate in the past can now reach many thousands of individuals within mere minutes. This rapid dissemination process can violently amplify excitement, but it simultaneously multiplies the potential for confusion and misinterpretation. When one participant posts that their regional bank is updating foreign currency procedures, many others may instantly interpret this as explicit confirmation of a global pattern, even if the individual updates are entirely unrelated coincidence. The sheer velocity of online communication makes it exponentially more difficult to objectively separate genuine, insightful analysis from purely random events. This is why experienced follow. WERS consistently advise viewers to focus on macro, verifiable patterns rather than fixating on isolated, single pieces of information. However, despite this prudent advice, the speed of the current conversation has generated an undeniable momentum that continues to propel the narrative forward. The energy fueling this discussion has developed a life of its own, powerfully sustaining continued interest in the idea of a global banking alignment. Certain community participants are intently focused on the possibility that influential international organizations might be actively encouraging regional banks worldwide to simultaneously upgrade their compliance standards. These global bodies frequently issue comprehensive guidelines that impact everything from anti-money laundering (AML) protocols to the strict reporting rules for international currency exchanges. When these guidelines are officially updated, banks in a vast number of countries are compelled to adjust their internal processes, retrain staff, or overhaul software systems within a shared common timeframe. To an external observer, this coordinated action could easily appear to be synchronized movement directly connected to specific currencies. But once again, the analytical challenge remains in definitively determining whether the system updates currently being discussed are part of a typical routine cycle, or if they represent an unusual, unprecedented level of synchronization. Regardless of the actual truth, the intense speculation highlights the microscopic level of detail with which followers are scrutinizing every aspect of global financial operations. A key point emphasized by proponents of the coordination theory is the increasingly interconnected nature of the global financial system today. International trade, massive digital payment networks, and the constant flow of cross-border currency require banks to operate within highly shared and interoperable frameworks. Because of this structural reality, coordinated systemic adjustments are argued to be far less rare than skeptics might assume. For example, updates related to settlement windows, the integration of digital ledger technology, or the adjustment of international transfer limits often roll out in predictable waves across numerous countries simultaneously. While this type of synchronization could easily be mistaken for something related to specific revaluation events, supporters argue that even if the current updates are not directly tied to a dinar or dong value change, the overall strengthening and modernization of global financial infrastructure still establishes a necessary foundation. This stronger foundation, they argue, would make it exponentially easier for countries to execute currency policy adjustments in the future. In this interpretation, what others view as merely routine maintenance is seen as a critical component of a much larger foundational strategic picture. Whether this interpretation is analytically sound or overly optimistic remains one of the central, continuous debates currently fueling the community's dialogue. Another analytical angle being explored is the possibility that Iraq and Vietnam are themselves preparing for extensive long-term financial reforms, even if no major immediate currency adjustments are currently planned. Iraq is relentlessly focused on diversifying its economy beyond oil, advancing its digital banking sector, and achieving greater international financial integration. Vietnam continues to solidify its leadership in global manufacturing, refine its foreign investment strategies, and expand its export partnerships. These fundamental long-term national improvements will, inevitably, influence the future strength and positioning of their currencies. Some community members interpret the claims of worldwide bank synchronization as explicit signs of preparation for future, potentially gradual transitions, rather than for a sudden, dramatic event. They suggest that global systems may be proactively aligning to smoothly support the international handling of these currencies. as the underlying economies evolve and mature. Yet, the opposing argument holds that even if undeniable long-term reform is underway, it does not provide any evidence that sudden dramatic currency changes are imminent. These two divergent interpretations, one deeply hopeful and the other strictly cautious, are the primary forces shaping the ongoing conversation within many online groups today. Furthermore, a powerful contemporary influence being discussed is the rapid evolution of decentralized digital assets and their increasing impact on global financial systems. As more nations actively explore digital currency frameworks or initiate central bank digital currency (CBDC) pilot experiments, private banking institutions must continuously update their internal systems to remain compliant and competitive. These necessary updates frequently demand cross-border coordination, which can easily appear synchronized to observers, even when completely disconnected from specific, established currencies like the dinar or dong. Individuals who closely follow financial technology trends argue that a large portion of the current global banking activity is being driven by this systemic push toward establishing more secure, highly efficient, and thoroughly digitized financial environments. This perspective helps to explain why so many banks might be making procedural adjustments simultaneously. However, currency watchers who remain optimistic about revaluation possibilities often interpret these digital transformations as integral components of a broader epochal shift that will ultimately facilitate future currency adjustments. Thus, the conversation effectively blends cutting-edge financial technology developments with long-held currency expectations, creating a highly intricate picture that continues to generate intense debate. One of the most psychologically compelling aspects of this current moment is the community's attempt to interpret silence. When official institutions, banks, regulators, or government agencies choose to remain quiet, one faction believes it strongly indicates that something massive is covertly happening behind the scenes, necessitating absolute secrecy. Conversely, the opposing view argues that silence is a perfectly normal, standard operating procedure because major institutions almost never comment on or validate speculative community discussions. This natural tension between deeply felt expectation and standard operating reality is common in the currency world, but it feels particularly amplified right now. Many viewers are rigorously searching for clues or indirect hints through ambiguous signs, such as reports of unusual banking hours, temporary system outages, or updated verification requirements. While these details may often reflect nothing more than routine maintenance or internal procedural updates, the absence of official explicit explanations allows speculation to grow naturally and aggressively. This environment forces participants to make a critical personal decision about whether the prevailing silence is truly meaningful or simply the normal state of financial affairs. The community is also actively debating what verifiable, true confirmation would even look like. One group asserts that confirmation must take the form of clear, unambiguous public announcements from national central banks or major international financial institutions. Another believes that early hints might surface through internal, leaked memos, sudden, unexplained shifts in frontline bank procedures, or unusual sustained changes in public exchange rate displays. A third, highly pragmatic group argues that genuine confirmation will only arrive when physical, noticeable changes are implemented and observed at banks worldwide. This wide variety of interpretations means participants will react entirely differently to the exact same information. A single public update could be perceived as irrefutable proof by one individual, yet simultaneously dismissed as entirely routine by another. This inherent diversity of interpretation is what keeps these conversations perpetually active and intense, as everyone attempts to determine which indicators possess true meaning and which are merely distractions. The very idea of global coordination also inevitably raises complex questions about the logistics of timing. If banks globally were indeed preparing for a major coordinated event, would they all need to act on the exact same day? Or would a phased, staggered approach be more realistic and manageable? Some community members argue that flawlessly synchronized timing would be absolutely essential to prevent inevitable market disruption and arbitrage. Others counter that a staggered implementation would be a more realistic necessity, especially given the vast differences in national regulations, local time zones, and the complexity of diverse banking systems. This internal debate naturally leads to much deeper discussions about the technicalities of international system communication, the process by which currency values are officially published, and how financial institutions manage systemic cross-border risk. These are profoundly complex subjects, demonstrating that the community is not merely reacting emotionally but is attempting to rationally reason through the massive logistical challenge that global coordination would practically involve. Emotion continues to play a major, unavoidable role in how people respond to these claims about banking synchronization. Some individuals are deeply encouraged, feeling that the world is finally aligning for long-awaited positive changes. Others remain deeply cautious, consistently reminding the community that hope should never be allowed to overwhelm market reality. Still others feel a deep sense of frustration, having repeatedly witnessed similar claims in the past that ultimately failed to deliver any major developments. This emotional diversity is entirely natural in any long-running financial discussion, especially one involving currencies with such complex histories and uncertain long-term futures. However, this emotional energy is precisely what catalyzes and sustains the conversation's rapid growth. Every emotional reaction, whether it is excitement, skepticism, or frustration, fuels more discussion, generates more pointed questions, and drives more attempts to objectively understand the true underlying reality. The collective emotional energy invested in this topic is a powerful, self-sustaining force, and it is a key factor explaining why the conversation continues to spread so aggressively across the entire currency community. Another analytical layer influencing this moment is the context of major, overarching global economic trends. International trade patterns are shifting rapidly. Inflation levels vary significantly between regional blocs. Countries everywhere are proactively reassessing their financial strategies to fortify long-term economic resilience. Major global events, such as adjustments to global supply chains, massive developments in energy markets, and intensifying geopolitical tensions, all fundamentally impact how currencies are valued and how banking institutions must prepare for the future. Some currency watchers believe that these enormous structural economic movements may be creating the necessary conditions for international banks to align their financial systems more closely. They argue that large-scale global challenges necessitate coordinated solutions, making synchronized banking updates a more probable reality. Conversely, others interpret these trends as clear signals that global markets are becoming increasingly cautious, leading banks to reinforce their internal systems simply for security, without any inherent connection to specific currencies. Whether interpreted with optimism or strict analysis, these broader economic forces undeniably shape how the community perceives the possibility of a coordinated global action. As this intensive conversation continues, many experienced long-term community members emphasize the critical necessity of staying grounded. They consistently encourage viewers to meticulously follow official government and central bank updates, rigorously track verifiable real-world economic indicators, and actively resist allowing rumors to overshadow documented facts. Their essential message is not to dismiss potential possibilities out of hand, but rather to maintain rigidly balanced and realistic expectations. They remind newer followers that the speculative currency world is constantly filled with unverified claims, and the only truly reliable conclusions are those derived from careful, objective observation, rather than from purely emotional reactions. This commitment to a balanced approach injects a crucial element of stability into the rapidly evolving conversation and strongly encourages critical thinking. It also powerfully reinforces the fundamental idea that while excitement is a natural human response, clear, official confirmation is absolutely essential before any firm conclusions can be reached. Their presence and persistent message add a vital layer of measured stability to what is otherwise an extremely volatile, rapidly evolving narrative. Simultaneously, the optimistic voices continue to share compelling reasons why they feel the current moment is uniquely significant. They point to the widespread, accelerated adoption of global digital systems, the modernization of core banking platforms, and the unprecedented increase in formalized communication between major financial institutions as clear signs that major transitions are logistically easier to implement now than in previous decades. They argue that synchronized, global banking adjustments could be part of a much broader, organized effort to significantly improve global financial stability, transparency, and efficiency. Some optimists believe that the long-term, verifiable economic growth taking place in regions like Iraq and Vietnam will eventually support substantially stronger currency positions, and that the current global banking preparation is proactively occurring to accommodate those future inevitable changes. Whether this hopeful viewpoint proves accurate or not, it undoubtedly introduces a compelling, forward-looking dimension to the discussion and sustains the engagement of many people in watching every new development. As we move deeper into this conversation, the single most critical point remains that the community is demonstrably more alert, more engaged, and more active than ever before. Participants are analyzing minute details, OSS referencing conflicting reports, questioning underlying assumptions, and sharing insights across numerous platforms simultaneously. This massive, collective effort creates a powerful environment of curiosity, shared observation, and rapidly growing knowledge. Regardless of whether the persistent claims of global coordination ultimately prove to be directly connected to specific currency events, the sheer level of sustained engagement demonstrates how deeply passionate and highly informed this community has become. Viewers are no longer simply waiting passively, they are actively examining the vast interconnected global financial landscape and attempting to independently comprehend the complex direction in which the world is collectively heading. This high level of proactive engagement is one of the clearest, strongest indicators that the currency community will continue to evolve, grow, and continuously refine its understanding of the intricate global financial system. As the discussion continues to expand and deepen, one fundamental reality becomes overwhelmingly clear. The global financial system is exceptionally complex, highly interconnected, and in a state of perpetual evolution. The claims circulating about synchronized banking activity necessarily touch upon numerous different facets of this complexity. They raise profound questions about the strategies financial institutions employ to prepare for future changes, the sophisticated communication protocols that govern global systems, and the eventual positioning of national currencies within overarching economic shifts. Whether the current wave of claims reflects something genuinely significant or merely the natural, routine rhythm of global banking operations, it highlights the paramount importance of staying well-informed, maintaining critical balance, and approaching the topic with intellectual rigor. The community's diverse reaction, a complex mixture of deeply felt hope, analytical caution, high excitement, and methodical analysis, powerfully demonstrates how passionately people care about understanding the future potential of these currencies. In closing, the widespread claims of worldwide bank coordination involving the Iraqi Dinar and Vietnamese Dong have decisively sparked one of the most active and intense conversations in recent history. The objective truth behind these specific claims remains elusive, and different individuals interpret the exact same information in profoundly different ways. Some participants interpret these reports as clear signs of preparation, while others dismiss them as routine, standard operations. Some feel an overwhelming sense of optimism, while others wisely encourage relentless patience. But the vigor of the debate itself serves as a crucial reminder of how essential it is to approach these complex topics with clarity, sustained awareness, and an unshakable, steady mindset. The global financial environment is changing at an accelerating pace, and truly understanding those changes requires both immense curiosity and unwavering caution. Whatever the future ultimately holds, the currency community remains actively engaged, deeply thoughtful, and committed to watching every development with intense scrutiny.